Our agenda today will be a brief introduction on who we are and what we're doing, the history of Titan Capital Holdings. First part of the PowerPoint presentation is going to discuss what is a real estate fund, the benefits of investing in a real estate fund, how to choose the right real estate fund, how to use an IRA 401k to invest in a real estate fund, and then the second part of our presentation will introduce you to the Titan Capital Real Estate Fund. So we'll talk about the Titan Capital Real Estate Fund 1, how to earn 10% secured, how a real estate fund is secured, and the risks associated with the real estate fund. The introduction: Titan Capital Holdings, LLC is a licensed private money lender and real estate investor in Arizona, Nevada, and California. We are also adding Florida at this time. Titan Capital Holdings provides investors the opportunity to participate in the Titan Capital Real Estate Fund 1, which provides consistent, above-average returns secured by real estate. The history. Titan Capital Holdings was formed in 2009 with its initial fund, which was designed to provide short-term bridge loans to investors buying foreclosed properties at public auction. Titan has since expanded to provide short-term bridge and transitional financing to real estate investors buying properties that are REO, which means real estate owned or bank inventory, or traditional resale transactions. Titan provides residential construction financing on pre-sold homes or other qualified projects and will acquire real estate that presents significant opportunities. Since 2009, Titan has made more than 385 loans with only 6 defaults and no loss of investor principal. We are proud of our accomplishments and currently have over $14 million under management. The 6 defaults that we had were 3 by way of deed in lieu of foreclosure, which means we had 3 different investors who got in over their head and gave the properties back to us, and 3 by foreclosure. I'll get into why the default rate is so low as we get further into the presentation, but that is well below the industry norm. Part 1, we are going to discuss what is a real estate fund, the benefits of investing in a real estate fund, how to choose the right real estate fund, how to use an IRA 401k to invest in a real estate fund. What is a real estate fund? A real estate fund is a collective investment vehicle that pools capital from investors. It is created, structured, and managed by a sponsor. So Titan Capital Holdings is the sponsor entity and the lending entity, and Titan Capital Holdings currently has 4 different funds. The fund we're speaking about today and introducing you to is our 4th and newest fund. It is typically structured as a private offering or Reg D investment. We'll go into that in more detail. Investors need to be accredited in order to invest in a private offering real estate fund. So an accredited investor is someone who has a net worth of more than $1 million, and that is exclusive of your primary residence, or an income of at least $200,000 per year as a single person or $300,000 per year as a married couple. That's the definition for an accredited investor, and that's who this fund and these funds are designed for. We have alternative investment vehicles for investors who are not accredited, and we can help you with any questions you may have in that area as well. Income is generated by the real estate fund by making hard money bridge loans, investing in real property, and that would be real property that we see profit potential in, buying pools of notes secured by first trust deeds. We do get opportunities to buy notes at significant discounts, and if we think that there's an opportunity there, we'll pursue it. Selling notes secured by first trust deeds. So that's the general nature of the real estate fund. The benefits of investing in a real estate fund. Capital invested is diversified across multiple investment types and amounts. Private real estate funds are non-correlated to the overall financial markets. What that means is if the S&P 500 or the Dow is having a good day or bad day, it does not directly correlate to our real estate funds. Investors have the advantage of the expertise and resources of the investment sponsor. That would be Titan Capital Holdings, myself, and our team. Professional management and reporting. How to choose the right real estate fund. Review the track record of the sponsor, strength and expertise of the management team, diversification of the sponsor, types of investments the real estate fund will make, how the real estate fund is secured, back office support, and reporting that's provided. How to use an IRA 401k to invest in a real estate fund. This is a big, big development that a lot of investors are not aware of, that you can self-direct an IRA or 401k into a real estate fund. The IRA 401k funds must be in a self-directed plan. You must use a custodian. We have several custodians that our funds have already been approved with, that we work with, so we can help you with any recommendations in that area if you need some. You can have multiple custodians if you have multiple IRAs or 401ks. The real estate fund must be approved on a custodian platform. As I mentioned, Titan and our funds have been approved on probably more than 7 or 8 different custodian platforms at this point. Talk with one of our team members. We can help you set up your IRA and 401k in a self-directed manner if you would like some help that way. Part 2, now we're going to get into the Titan Capital Real Estate Fund 1 and more about Titan Capital Holdings, how to earn 10% secured, how a real estate fund is secured, the risks associated with the real estate fund. Now let me introduce you to Titan Capital Holdings and the Titan Capital Real Estate Fund 1. Our company slogan, which we like, helping create and facilitate investment opportunities. That goes for our borrowers that use our capital as well as our investors who invest in the funds. Preferred interest. The Titan Capital Real Estate Fund 1 is proud to provide a preferred interest to our investors at the annualized rate of 10% secured by first position deeds of trust. Our investors' preferred interest is paid out on a monthly basis and can be reinvested or taken as monthly income. I'm going to talk for just a minute about the 10% secured. It's interesting what we've learned over the last few years. We get 3 basic responses to that. One is that it's too good to be true. The other is that it's not enough. And the third is it's just right, where can I sign up? Truly, we get all 3 responses to that return that we offer. The fact is that we are a short-term bridge lending business, and we generate annualized returns of between 16 and 18%. So we pay our investors 10%, and the margin is what we live on and run our business with. So it's a fairly simple model. The rate, in fact, is not too high, it's not too low, it's not too good to be true. It is a function of our business model and the annualized revenue that we're able to generate on the capital that's invested. The vision. Titan's immediate goal is to grow to $50 million under management in the markets of Arizona, Nevada, and California. As I mentioned earlier, Titan was formed in 2009 initially to help investors picking up properties purchased at public auction here in Arizona. Our sister company, Infoclosure.com, has since expanded through Arizona, Nevada, California, and now opening up in Florida. And Titan is basically supporting that business platform in addition to other investor transactions that are out there. But we opened in 2009 with one investor who wrote a $4 million check. That investor is still with us today. Our second investor wrote a $500,000 check. That investor is still with us today. And we've grown from $4 million in 2009 to $14 million today. But we have significant demand in our marketplaces, and that's why we're pushing to raise capital for our funds. This projection is based on our ongoing deal flow and expanding market share in the key markets we serve as our capital platform grows. We have a demand of no less than $1 million a week from qualified investor borrowers for our funds in our marketplaces. The need for short-term bridge financing for real estate investors and builders is significant. Titan's business model is strategically positioned to take advantage of these opportunities. The fund offering structure. The Titan Capital Real Estate Fund 1 is considered a Reg D 506C. So this is an SEC registered, otherwise known as Securities and Exchange Commission registered, Reg D 506C. The newest significance with this fund is that we are now able to solicit investors and introduce investors to the fund. Prior to the Jobs Act of late last year, we did not have the ability to solicit investors into our funds. We could only have investors come in by way of known persons, otherwise known as the friends and family connection. But today we have the ability to reach out to a larger investor group and introduce investors to our fund, and it is classified a Reg D 506C. It is an equity offering. Investors must be accredited and become members of the fund. So I defined accredited earlier, and an equity offering where you become a member of the fund is equivalent to owning stock in a corporation. Because it's an LLC and the way the fund is structured, you become a member of the fund, again, just like owning stock in a corporation. Members receive a fully executed operating agreement. The fund structure, again, is a $50 million raise. There is a $10,000 minimum initial investment. Distributions are paid monthly. This is important. We pay our investors the 6th of every month. When we make a loan, our loan payments are due between the 1st and 5th of every month. They're late on the 6th. So by the 6th of the month, we typically have between 80 and 90% of all payments in. So our investors are always first to get paid. We have not missed an investor payment since 2009. Investors get paid first on the 6th. We do direct deposit, or we do ACH transfers, or by check, whatever suits the investor. Distributions can be reinvested. Liquidity, minimum 1-year commitment before requests for redemption may be made. We try to stay liquid for our investors, but we're also trying to grow a business. So we want all of our investors to think long-term with us. As I mentioned earlier, our 2 initial investors who are still with us today came on board in 2009. However, their capital base has fluctuated, has increased and decreased based on other needs or other investment opportunities that they had. So we do look for a minimum 1-year commitment. We do give our investors liquidity just by saying, you know, if you have a cash call need, give us a 60 or 90-day window, depending on how much you need, and we will satisfy that cash call. Because our loans are short-term in nature, we're always receiving payoffs, and money's always coming in, so a cash call is fairly easy to accommodate. We've had several cash calls over the years, and we've not missed one yet. The executive team. Rick Rickert is the CEO and founder of Titan Capital Holdings. Mr. Rickert is a veteran real estate investor of the past 15-plus years and has been involved in more than 2,000 real estate transactions. Mr. Rickert is also a licensed associate real estate broker in Arizona. Adam Child, president, that would be myself. I am a veteran real estate lender, originator, and underwriter of the past 24-plus years. I've been involved in more than 5,000 loan transactions. I'm also a licensed mortgage loan originator in Arizona. David Hartness, our executive vice president of investor services. David has been working with us over the last 3 years. He was instrumental in bringing in approximately $30 million that was used to acquire homes over the last 2 years through InfoClosure. And Mr. Hartness is now a full-time member of our executive team. Mr. Hartness is a veteran real estate advisor of the past 30-plus years, involved with $600 million of development and placing $80 million of equity for his clients. Mr. Hartness is also a licensed real estate broker in California. Our team. Ashley Child is a licensed Arizona originator. Ashley is my oldest daughter and an ASU graduate and has been with us for 3 years now. Cole Strebel is our licensed Nevada originator, and Cole's been with us for over a year now and came to us by way of Wells Fargo Private Client Services. So clearly Cole saw the need for our loan product that we have in the Nevada market as well. Lisa Karcher is a 12-year veteran of the mortgage lending industry. She is our loan coordinator and is in the process of becoming licensed as a loan originator. Nikki Wooldridge, who's been with us for over 3 years now, is our controller. Mark Windsor, who has worked with Rick directly for many, many years, is our legal advisor. Michael Tafoya is our trustee. Mitch Medgovich is our compliance advisor. Mitch is a 30-year veteran of hard money lending here in Arizona. He's considered one of the best. He is extremely knowledgeable in all compliance-related manners. Mitch is one of the best advisors we have. We are Dodd-Frank compliant. We adhere to all the requirements as a licensed, bonded, insured lender in Arizona, Nevada, and California, and soon in Florida. Our main corporate office is on the top floor of the Bank of America building in downtown Mesa, Arizona on Main Street. We are in 10,000 square feet, occupying the entire second floor of the Bank of America building on Main Street in Mesa. We have a physical office in the old downtown of Las Vegas, and we have an office in Culver City, California. The fund products. Opportunistic real property is purchased for its appreciation and income-generating potential with target markets located primarily in Arizona, California, and Nevada. Pools of existing hard money loans secured by first trust deeds with value-add potential are acquired to hold and for resale. Hard money bridge loans are made to real estate investors and secured by first position trust deeds. In addition to the points and fees, interest rates are in the following ranges for loans made through the fund. Our short-term product, which has been the most popular, 6-month, we're at 16 to 18%. Our 12-month product, 14 to 16%. Our 24-month product, 12 to 14%. And we do residential construction at 12 to 15%. And then there's fees and other costs associated with that. So when we talk about what an investor earns in the fund, when you look at the pricing of our products, you can see where our margin is there, how we pay our investors the 10, and how we earn our gross yield of anywhere between 16 and 20%. At the same time, with those yields, it doesn't give us a lot of room to pay investors more. We're actually trying to reduce the cost of capital over time, but for right now, that is our structure. Demand for fund products. As I stated earlier, Titan receives more than $1 million per week in qualified loan requests that fit our conservative underwriting guidelines. Demand comes from past and current clients and referrals. We possess a database of over 30,000 active real estate agents and over 40,000 active real estate investors. Our current demand comes to us with very little solicitation. When we ramp up our marketing efforts, our demand will come in and far exceed what we've got available to deploy. That's why we're continuing to raise capital for our business and grow our business. Titan provides education, direction, and guidance on how to benefit from using private money loans through its Academy of Real Estate and training seminars at our office. I am in our training room at our corporate office right now. We can seat anywhere between 30 and 40 people in this room. We have filled it up before, but a primary part of our business platform is to train and educate our borrowers and to train and educate our investors. And we have events here in our office on a regular basis to do that. Titan has become a preferred private money lender in its marketplaces. To just expand on the demand part a little bit, and these numbers are hard to imagine. Quite frankly, we just pulled this data together in the last month, and it really surprised all of us. But the first slide here is for the first quarter of 2014. This is the volume of properties sold to a third party at auction. Now, to be specific on the auction, I'm talking about public auction, homes that were foreclosed on and are being sold at the courthouse steps. That's what this data is, not any other auction. This is just public auction. Now, we all know that we're off the highs of the foreclosure activity, and actually we're getting back to the more normal levels of foreclosure activity that exists. And at these normal levels, look at the numbers that we're looking at here. You've got volume by units and by dollars. But basically, in the first quarter of this year, you have over 663 million transactions at public auction in Florida, California, Arizona, Nevada, only in those areas. That's a huge volume. The reason I point this slide out is to let you, the investors, see where a significant amount of our inquiries come from. And that is a significant amount of volume and quite a bit more than what we expected. You can also do some calculations there to get into average purchase prices in each one of those markets. But very, very significant volume. In addition to the last slide I showed you, I'm also going to show you investor cash transactions in the same marketplaces. Now, these transactions are separate from the transactions at public auction. The last slide I showed you here, those are only public auction transactions, so foreclosed properties available made available at the courthouse steps. This is in addition to that. This is cash transactions in Florida, California, Arizona only, and Nevada. I'm sorry, I missed the, we've got Nevada here, we missed it at the bottom here, but Clark County, Nevada. So almost $4 billion in cash transactions in these 4 states. That is a huge number. And the reason the cash transactions is a big deal to us is most of these investors who are buying these properties with cash represent potential borrowers for our money, because investors know how to use our capital as leverage to increase their real estate activity. So these are huge numbers, and we thought they'd be significant for you, the potential investor, to see. Where we lend and invest, Titan focuses primarily, I'm going to back up, where we lend and invest. Titan focuses primarily on the metropolitan market areas of Arizona, Phoenix, Tucson, and Flagstaff. In California, it's Los Angeles, San Diego. In Nevada, it's Las Vegas. In Florida, it will be Broward and Miami-Dade counties. Titan will not typically take on loans in remote or outer-lying areas. I was asked recently to look at putting a loan on a beautiful home in southeastern Arizona. It sat on top of a mountaintop, had a 3 or 5 mile long driveway. Without any doubt at all, the person that built this home probably spent $3 million building it. And the loan request was not for very much. It was in the $200,000 to $300,000 range. The problem is that's pretty unique. If you have to take the property back, it doesn't matter how nice it is, but given its remote location, it would really take quite a while to find the right buyer for that property. We do like to stay in the metropolitan areas of the states that we're in. Loan underwriting. We utilize the industry standard 1003 Uniform Residential Loan Application. All loans are processed using Calyx Point software. Titan looks heavily at the following 4 criteria. The collateral. We look at every loan we make as though we're going to take the property back, and if we take the property back, can we do something with it? Even though our default rate is extremely low, we still want to look at the property from the standpoint of, if it ends up back in our lap, can we get rid of it and get our money back? Is it a good piece of collateral in a good marketplace with good demand? We look at all those things. The borrower's capacity, their equity into the deal, their ability to pay. We do look at the borrowers. We look at their equity into the transaction. We require a minimum 20% down on cost as long as there's a 30% equity position that we can determine by our own research. If not, we'll ask for more money down. I think that item right there is one of the reasons our default rate is so low. Credit risk is assessed. We're not credit score driven. Our borrowers actually range in credit scores from 500 to 800, and our more typical borrower seems to be in the 650 to 750 credit score range. What we do look for is we look for a credit that we think is a problem. And we check all 3 bureaus. We pull credit on every borrower that borrows any funds from us. What we look at is if a borrower is in a bankruptcy, in the middle of a bankruptcy, or has significant tax liens, or is just what you'd call a habitual late payer, we're going to take a pass on any one of those scenarios. Should be for all the obvious reasons. And the exit strategy. Again, our loans are short-term in nature, made to investors. Is this a fix and flip? Is it a buy and hold for a period of time? Are they taking us out with another mortgage? Are they waiting for the market to appreciate a little bit? But we want to clearly know what the exit strategy of the borrower is. And again, here we require 20% minimum down on cost and a minimum 30% equity position. What that means is, keep in mind, our investors are typically buying properties at below market values. So if an investor is buying a property for $100,000 and we comp it out using all of our mechanisms for $130,000, then we see decent equity in that property and we'll take 20% down from the borrower. If the borrower is buying a property for $100,000 and we can't comp it for more than $100,000, then we're going to require at least 30% down. Fund asset valuation. In determining property values for loan underwriting, Titan utilizes the following valuation methods. The CMA, which is the comparable market analysis. The comparable market analysis we generate in our office. We have our own real estate company. We have access to MLS and all the records. So the first thing that we do always is we go straight to the comps, and we look at the comps. And it doesn't matter what market you're in. It all comes down to the comps. What's the turn time in that particular area? What kind of model match comps do you have? What do you know about that area? We can determine all that directly from MLS. It's the same tools that an appraiser uses or a BPO would be generated from. But we start with it in-house to just make sure we're going down the right path. We also do a BPO, which is a broker price opinion. That's a third-party valuation. We most typically use CMAs and BPOs on our shorter-term loan products, so anything under 12 months. If we're doing a loan for any longer than 12 months, we're going to always get an appraisal. And that would be the third type of valuation we use. Titan will often use more than one of the above valuation methods. We always start with the CMA first, and if it's short-term in nature, we'll typically back it up with a BPO. How the real estate fund is secured. The real estate fund is secured by first position deeds of trust. So here's how it works. Titan Capital Holdings is the licensed lender. Titan Capital Holdings has a demand for a loan. Titan will look at its various sources of funds to see where the capital is available. And in taking this fund, for instance, Titan will take an advance from the fund to make the loan. The loan is issued, the deed of trust is recorded, and the deed of trust is assigned back to the fund as collateral. So all the dollars in the fund are collateralized by deeds of trust, collateralized by the real estate that the funds are being used to lend out for. So it's the same security as if you were going out and buying a piece of property yourself and you were going to hold the deed of trust for that asset yourself. We execute a promissory note. Because our loans are short-term in nature made to investors, our promissory note has a personal guarantee. Title insured. Every loan we do is title insured by an extended Alta lender's policy, and it comes with a 104.9 endorsement, which means Titan is covered, and anybody Titan assigns that loan to, in other words, back to one of the funds or to one of our note buyers, anyone who participates with Titan on that particular loan receives all the same title coverages that Titan receives. Cross-collateral when appropriate, especially when we were working with investors who have multiple properties with us, we'll use a cross-collateral agreement to give us liens on additional properties to protect our equity position. Hazard insurance, again, a dollar never leaves here without hazard insurance in place. Hazard insurance being property insurance. We do not fund a deal until we have hazard insurance with Titan and or assigns listed as additional insured. So the notes are primarily short-term in nature. And we really like that because we think that adds a lot of security. If there's another catastrophic real estate event coming and all of our notes are starting to pay off because they're short-term in nature, we think we're steps ahead of protecting ourselves. That gives us the opportunity to see properties get paid off or to liquidate ourselves from the loans we're out on and to sit tight if needed if we think we're going through another major market correction. That said, I don't think we'll see one again for quite a while. Obviously, we just went through one of the worst market corrections in almost 100 years. That doesn't happen very often. But we do feel that the short-term nature of our loan products in the fund really enhances the security. Taxes, insurance, and special assessments. On our short-term loans, 6 and 12 months, we make sure all taxes and hazard insurance are paid up for the term of the loan. On our longer-term loans, 12 and 24 months, taxes and insurance are impounded. The risks associated with the real estate fund. When you invest in a fund or make any investment at all, there's always all kinds of risks that we're all aware of as investors. But when you invest in one of the real estate funds, it really boils down to just two key items. One is loss of income. Loss of income arises when a borrower fails to pay interest due on a note. That's going to happen, and if they go into default, then we're looking at a foreclosure situation. Loss of principal. Loss of principal could arise from a catastrophic move in property values. We just went through that, right? We just went through one of the most significant adjustments to property values most of us have ever seen. A $200,000 property clearly became worth $100,000, and now today it might only be back up to about $135,000. The good news is for us, we just went through it. We just went through one of the most catastrophic events in real estate that we've ever seen.